welcome everyone to episode 19, a special episode of Top of Mind. We are covering Silicon Valley Bank today, and we are recording this on Monday, March 13th. It is 11:21 in the morning. A lot of news has happened over the weekend. We recorded episode 18 on Friday, right as this news was breaking. Over the weekend, a lot of things have developed. We posted that episode today. So today at 5 a.m. that hit all of your devices, and we're recording an update now, which will go live either later today or tomorrow. So we just thought that we would give a high-level summary for what's going on, why is it happening, what's the impact to you as a client of Consilio, or really kind of anyone out there, and then what potentially happens next. I'm joined as always by Hao Dang, our Chief Explanation Officer here at Consilio.
CEO.
Who's going to help us. Yep, that's right. Who's going to help us break down what is going on. So, where should we start? Gosh, okay, I'll just kick off with this. This weekend, the second and third largest bank failures in the United States happened. The first being Washington Mutual back in 2008, which was right at the start of the great financial crisis. Silicon Valley Bank was the second largest bank failure, and Signature Bank was the third largest bank failure. So let me pause there. Hao, why don't you give us a summary for just what happened over the weekend, and we'll go from there.
Yeah, well, good seeing you, Chris. Hopefully the next time we see each other, it's going to be under funner circumstances, but the emergency pod has to go through. So let's start with Silvergate, because I think they're the first shoe to drop. So everyone, at least from what I'm getting from the headlines, feels like it was Signature Bank. It was Silicon Valley Bank. All these S-name banks is really fumbling with me.
Yeah.
Silicon Valley Bank is essentially the second bank to fail in this, I guess, the higher rate regime. But it was first Silvergate. Their exposures were mostly with crypto. So they were taking assets from, let's say, Bitcoin or Dogecoin or whatever coin people thought they had value behind, and they stored it with Silvergate. And Silvergate did pretty well through 2020 and 2021 for the most part by doing this, because they were really one of the few banks, along with Signature Bank, which is the third shoe to drop, that they would do business with crypto exchanges, or essentially be the hub for crypto traders or investors. I don't know what you call them. Crypto broke people. I don't know how there's any value there. So since there's no value behind it, all this business that they've been doing, and with the collapse of crypto in the last 3 or 4 months, where they're experiencing essentially what's a bank run, but they lost value of their collateralized assets. So they can't stand on their own 2 feet anymore. So that was the first bank. The second bank was the one from Friday, Silicon Valley Bank, SVB. They catered specifically to startups, and startups have been pretty cash starved, right? We're not talking about established businesses that have a war chest of money like Apple, right? Or, they're maybe not even profitable. So they're relying on venture capital, in lump sums that are parked at the bank, right? So if you got a Series A, Series B, C, D, E, F round funding, you're taking that, let's say, multiple millions of dollars and parking in the bank to operate, to stay in business. So you use that for payroll, you use that for leases, you use that for any subscription services, right? A lot of these companies use SaaS or other types of cloud storage, right? So the impact of this particular one was the nature of their client base or the customer base, right? When you serve that, that niche of a market, when that market suddenly can't hold itself up, at least in terms of generating new cash or depositing in new cash, then they're going to need cash coming from the bank, which has been supplied by new deposits from new venture capital deposits, right? It's always kind of feeding itself when this kind of money is so easy to access. You're going to get new deposits to back the withdrawals. But when interest rates rose, the amount of deposits slowed first, but then the amount of withdrawals kept pace, and if not accelerated, right? So we got this double whammy from a bank's point of view, where you're not taking in new deposits, but you're getting liquidated for business reasons. It's not for speculation or anything like that. And I think that came to a head on Friday. Well, it did. Not think, right? That it really did happen, and
Fact.
They were forced to close, right?
Mm-hmm.
And then what was the third bank?
Signature Bank.
Signature Bank was similar to Silvergate, where they had a crypto wing. It wasn't as concentrated as Silvergate, but they were impacted by the crash of crypto assets.
Yeah, Signature Bank also had some business customers as well, but they were impacted by the crash in crypto. So, but yeah, to your point, it seemed like the first shoe to fall was Silvergate, which then kind of spooked the rest of this. But it's interesting how something that seemed to start over in the crypto space then became, the word now in the news is contagion, became sort of a contagion in the regular banking space, and particularly here in this bank that services VCs and startups. For context, so there's 120,000 startups and VCs in the U.S. 50% of them bank at SVB.
Yeah.
So there was a very big concentration here. And with all of the VC funding over the last number of years, Silicon Valley Bank has grown a ton. So a little stat here. So March of 2021, the bank's total deposits over the next 12 months went from 62 billion to 124 billion. So they doubled. They went up 100%. For context, over at Chase went up by 24%. First Republic Bank is also in the news right now for a lot of reasons, but they were up 36%. So again, the key here is a lot of deposits went into the bank, and then the bank needed to invest those deposits as banks do, and then withdrawals happened, which caused this forced sale. Let's go through the play. Yeah, let's go through the play-by-play there. So kind of the first step in this. So whether it was Silvergate or whatever, but apparently VCs started telling their founders and their portfolio companies to pull money from Silicon Valley Bank. This could have been because of the cash withdrawals at Silicon Valley Bank, and it was under intense scrutiny, because they looked like they needed to raise capital. But there was also a newsletter that went out by apparently a prominent person in the VC community that every VC reads this letter, and potentially that has what's caused all these VCs to basically say, hey, get your money out. So that started, this letter went out. VCs then started sending messages to all their companies, said get out. That effectively triggered the run on the bank. And let's be clear here that probably no bank, even though the U.S. banking system is very, very strong and resilient at this point, much due to regulation coming out of the great financial crisis, no bank can withstand massive withdrawals of cash. Every bank would have to fall to the FDIC if that were to happen. So that is what happened here. So the bank effectively had to sell $21 billion in bonds in order to meet their deposits. Effectively on Thursday, they had a massive withdrawal. So I'm just going to read a statement by the FDIC here. So March 8th, the bank announced a loss of approximately $1.8 billion on a sale of investments. So they sold roughly $20 billion of mortgage-backed securities and U.S. Treasuries in order to raise cash to meet ongoing withdrawals. They lost $1.8 billion on that sale. So then they turned around and they conducted a capital raise to raise about $2 to $2.5 billion by selling stock. The problem with that, and selling stock in their own company, the problem with that is that the stock went down 60% 2 days in a row, which makes it a lot harder to raise that much capital when your stock is so low. on March 9th alone, initiated withdrawals out of the bank were $42 billion. That was 25% of all of the deposits that they had. At the end of business on March 9th, the bank had a negative cash balance of $958 million. The bank tried to raise money. They couldn't do it. And immediately the Federal Reserve has to take over based on that precipitous cash withdrawal. They're deemed as insolvent. So all of that happened.
How quickly that action occurred too, the takeover.
Yeah, exactly. I mean, truly, I'm stepping back here, and what an amazing system that a bank can fail, yet the Federal Reserve can take it over, and the FDIC insurance steps in. They initially said, "Hey, if you have $250 in the bank or less, you're good," and then you're going to get a note that when we ultimately sell the assets, you'll get whatever your cut is back. This is a bank that the vast majority of deposits were well over $250,000. This is a business bank. There's millions and millions of dollars of cash sitting there. And so that could have caused huge fallout. And so the Federal Reserve ended up coming in and saying, we'll back all of it. And to be clear, this was a backing of the deposits. The shareholders are not getting anything, the bondholders are not getting anything, and the executive management has been removed. So this is not necessarily the bank bailout of years ago. People got fired, shareholders don't have anything, but the deposits, the businesses that just chose to store their cash there and they weren't doing anything wrong, those people will be made whole.
Yeah, I think Chris brings up this very novel point is the Silicon Valley Bank was allowed to fail. It did fail. So stockholders lost everything. Equity holders lost everything. Certain debt holders or liabilities will not be made whole, but that's kind of the position that investing in a debt security can happen, right? Sometimes loanees, I guess, fail to pay their debts, and that's the risk. So the government did not bail out the bank. I think we have to be really clear on that. They bailed out the depositors, and I think that's a really, really important distinction.
It's also worth noting that over the weekend, more than 100 venture capital firms signed a statement saying that they would continue to work with Silicon Valley Bank, provided that the bank was sold to another entity. And so, effectively, the point of confidence there was, hey, this isn't the bank's fault. The bank didn't trigger the run. The run happened, and then, once that happens, the bank just goes insolvent. So it wasn't that the bank was doing bad things necessarily. This statement was started by General Catalyst, who's a pretty well-known VC down in the Bay Area, but Sequoia, Kleiner Perkins also signed this. These are quite well-known VCs, as well as many, many more. The General Catalyst CEO came out and he said, the run on the bank was an unintended consequence of many investors trying to do the right thing for their own portfolio companies. Panic wasn't the way to handle it.
Yeah, well, from the company's point of view, is you got to make payroll, and if you hear even a whiff of a bank run, to preserve your company, you have to be first to withdraw. And as bad as an outcome as it's been, the companies that were able to get their money out first didn't stress about meeting payroll or not, and the ones that didn't have limited access to the funds today. And can you operate like that? That's a very, you can't operate a business if you can't pay bills or pay payroll.
It's a question here that you might be able to help us understand. So the Federal Reserve came out on Sunday saying that they would fully back deposits, right? So previously they said only 250 and below will back. Excuse me. They said we'll fully back it, and they're doing a similar thing at Signature Bank as well. And they said, everybody has access to their money Monday morning, which I haven't heard how that's going. I haven't heard if you just log in, your money's sitting there, or how smooth that's been, but that's what they said would happen. They said, the Federal Reserve said, as a result of, or part of all this, no losses will be borne by the taxpayer. Do we know how that works at this point, or can you give us some clarity on that if you happen to know?
Yeah, I think, well, again, the losses by the taxpayers, if we go back to 2008, there were actually zero taxpayer losses. There was actual gains, right? But the issue is it is funded by taxpayer dollars, which they're confident they could get back. So let's say you got $100 billion in deposits that you need to honor, but you have $100 billion in assets that have varying levels of liquidity, meaning I could sell some of the stuff tomorrow and get 40 billion, for example, and cover 40 billion, but I got a $60 billion gap, which includes stickier assets like real estate or non-traded assets or whatever the case is. Those things take time to liquidate, right? Let's say Silicon Valley Bank owned these buildings. I can't liquidate a building in a day. I got probably multiple years to get out of the contracts, get out of the lease, and then finally sell it. So that period, that lag period between liquidating the assets all completely to pay for the liabilities, I think that's what the government is covering, meaning you got $100 billion here and potentially 100% of it will be drawn down, which is, again, that money belongs to the depositors, no one else. The bank doesn't own them, right? So what the government was backing was that access to that $100 billion. And then what they have here on this other side is, worth assets that are worth something that it just takes time to sell. And I think but that gap between being able to sell those assets and the liquidation of those liabilities, I think that is taxpayer funded. So the statement from the Fed and the Treasury saying it doesn't include taxpayer money, yes and no, because they're confident that the taxpayer will be reimbursed for it. But at the same time, we're staking up our assets to back someone else's liability. So I think that's a bit misleading from my point of view, because it does have to get funded by someone, and that's us.
Right.
Yeah.
Right. Interesting. Yeah, we'll see. So, and what Hao's referring to there is the TARP program that came out in the financial crisis back in 07, 08. TARP was the Troubled Asset Relief Program that was essentially a huge blank check to bail out all the big banks and stabilize the financial system during that time. The TARP ended up being about a $40 billion program, and it ended up returning somewhere around $55 billion back to taxpayers. So there's like a $15 billion profit with that whole program.
Well, the anger, I totally understand the anger behind it, where some companies were able to, stay in business. Look at AIG; it's still operating. The difference is there's not going to be a Silicon Valley Bank. It's gone. AIG, so yes, that was a bailout, but the other alternative there is financial collapse, right? And prior to the system, we let banks close and shutter, and depositors were never made whole. And I'm going back to the 30s, 40s, 60s, right? 50s and 60s, where the role of the FDIC and the Federal Reserve really have been worked out through those decades, right? People had to suffer pretty badly. And I think this is, I made a mention of how quickly the administrative process went, but I think we've had quite a bit of experience in working it out over the last 100 years.
So I want to come back just for a point of clarity. So at Silicon Valley Bank, essentially the bank doubled in a matter of a year. And so then the bank had all these deposits that they needed to invest. And banks don't hold enough cash and actual cash to meet all their deposits immediately. If you go into the bank and you ask for enough $20 bills, they'll say, we don't actually have those here, for example, right? They need to go transfer them. So cash is invested. And so what happened is, with all the great VC funding over the last number of years has doubled the size of the bank said, okay, we need to invest some of these funds. And so they had at basically the time of these withdrawals, they only had about 14 billion in actual cash. They had about 26 billion in things that they could sell quickly. And then they had another 91 billion in what they call HTM, securities, hold to maturity securities, things that they aren't planning on selling before maturity. It was that sort of tranche of assets that they invested a lot of this excess cash in. And I believe those were mostly 3-year treasury bonds that were paying about 1.6%. And what happened was they needed to go and sell some of that 91 billion. They sold about 20 billion of it. And because of where interest rates have gone, they lost money on it to the tune of about 2 billion, then had to do the equity raise. Again, outflows still were way more than deposits. They couldn't raise enough cash and seized by the FDIC. But I just want to provide a little bit of context for that because the bank was effectively doing the right thing. They were investing their deposits. This is just a classic mismatch of the liabilities of the bank and the timing of those investments.
Yeah, on like a 10,000 foot view, that's what banks do is they'll take assets that they believe won't get called, right? Essentially, those deposits that they experience were in 2020 were going to be the way 2021 and beyond, right? And I think that's a mistake a lot of people made in this post-pandemic era was when you had a growth pattern of a certain way during the pandemic. The biggest mistake was to assume that growth pattern would continue, right?
Right.
And when you start doing your actuarial tables, thinking, hey, this is the rate of withdrawal, right? Let's say it's 10% a year, and 90% we can safely put in 2 years, 3 years, 4 years, and beyond. That's where you would get in trouble once your forecast starts breaking down when the withdrawal rates suddenly increases, or on the flip side, the deposit rate decreases.
Yeah.
So now, but they got sandwiched, and the amount of deposits slowed down, right? And we talk about interest rates, but this is important where venture capital has a hurdle rate suddenly of 0, right, in 2020. Interest was earning 0. Now the hurdle rate's 5%. And when you're talking billions of dollars, that 5% versus 0% is incredibly valuable to you as the venture capitalist. And to start funding these startups that probably have 0 path to profitability, you're not going to get many investments as you did in 2020 because capital is so much cheaper. So yeah, this is a result of easy capital and quickly tightening capital. So we're seeing a full market cycle in a matter of like 2 years. So again, Chris and I aren't letting the bank off the hook, but there's a lot of things that happen here where it created this perfect storm, right? You think about how far behind the curve the Fed was in 2021, saying inflation was transitory, we're going to keep rates lower because we're not so sure about the economy, right? And then all of a sudden, oh yeah, inflation's here to stay. We're going to jack up rates by 0.75, 0.75, 0.5, and basically hike until something breaks. And I think we got something to break.
I posted this on LinkedIn on Friday, and I said the Fed's been swinging around their cannonball, and I think they finally hit something. Yeah, and that this could be that, right? What exactly you're explaining is they wanted things to slow down, but this particular bank with 50% of its customers in the industry that is getting kind of no funding right now, is the exact perfect black swan storm that causes this. I just want to take a moment too and expand on bond rates. I know that we've talked about this before. We talk about this a lot with clients too, and many of our clients, but really anyone out there has seen negative returns on their bonds last year.
Yep.
And this bank also had that issue, right? It's the asset liability mismatch of, well, we need this money maybe in 3 years, so we're going to invest it at 1.6%. If they didn't have to sell it, they wouldn't have lost money.
Yeah.
But they had to sell it, so they lost money, and that's the issue here. Let's imagine that you bought that same bond. I'll keep the math a little easier. You put $100 in a bond, and it was paying you 2%. If you held that bond for 10 years, you'd make $122. Now, today, that same bond's paying 5%. So if you bought that bond $100, 5%, you held that bond for 10 years, you'd make $163. So the total rate of return goes from $122 to $163. The point is, when interest rates go up so much, the bond price must go down in order to compensate, because you're the one holding that 2% bond. So it goes down by 25%. The difference between $163 and $122 is 25%. The longer dated bonds, the greater this fluctuation is. Shorter dated bonds, the lesser the fluctuation. But that's exactly what happened here to the bank, is those assets on our balance sheet that they didn't think they needed, that they did need, weren't worth as much as they needed them to be when they sold them. And that is exactly what spiraled.
Yeah, because you use the key term. They categorize it as held to maturity. And when you sell a CD early, you're taking a penalty. And essentially that's what they did was U.S. Treasury bonds are risk-free in the sense that they haven't defaulted, but they're not risk-free in terms of interest rate movement. So what Chris described there is an opportunity loss there, because if I were an investor buying Treasury bonds and they were paying 5% and someone like Silicon Valley was selling it at 1.2%, believe me, I'm going after the 5% bond day in, day out. So how they make up for that difference is they're discounting the bonds that they're holding by the tune of 10% below, right? Because their shortfall was $2 billion on $20 billion in sales. So that's pretty straightforward, easy math. But yeah, if they held to maturity, the issue was they couldn't, right? They had to come up with fresh capital to feed this beast that had been withdrawing for the last year and a half.
Okay, let's shift over to how are our clients impacted. Really, how is anybody impacted from this?
Yeah, these banks are publicly traded. All the ones we mentioned, in addition to First Republic, right? They all have index exposure. Specifically, they have greater exposure in small cap and mid cap value because they are relatively smaller companies. But those are the exposures outside of having direct ownership of the KRE regional bank ETF or SBNY ticker, where we're seeing very low allocation to it if you're in the S&P. So the S&P 1500, which is like the broad market holding, they're less than 0.05 basis points. I can't count how little the decimal is, like, so it's like a 1/1000th of a percent.
I did some math on it because I was struggling with that many zeros as well. So as of the end of February, Silicon Valley Bank represents approximately 0.05% of the S&P index. So that is not 5%. That is not 0.5%. That's 0.05%. So what is that? So if you have $100,000 in the S&P, 0.05% of that is $50 in the stock. And of course that scales up and down with how much money you have in the S&P. First Republic Bank is 0.04. Signature Bank 0.01. So even smaller. But the point is, those are just relative weights of the S&P 500. If you own mid-sized companies and small-sized companies, you likely have a greater exposure there because these companies are a larger weight in a smaller index. But the potential, again, there's no good news here, but I guess the good news is that these companies are relatively small. So the impact to you as a owner of the S&P or a similar index, which is likely what you own in part with us and potentially on your own if you're not a client of ours, is relatively minimal with those specific stocks.
Yeah, and I think the biggest risk is if you have direct ownership of the regional bank ETF or any regional bank. I know prior heading into this, and I know you're going to see a lot of people who said, "Oh, I saw it coming." One, don't believe them. I think that the biggest narrative heading into this was banks, especially regional banks, were financially healthy.
Yeah.
Right? And the amount of health is obviously being pulled back because, regulation changes in 2018. But we're looking at one, as a banking system, had never been so flush with cash, right? We were talking about how banks had no incentive to give interest rates on their savings rates because they don't need new capital, right? Again, that looking back was probably more of a direct commentary on the bigger banks that, if you're banking at those big national banks, they're not giving you any percentage on your savings. But the smaller banks, maybe could have stemmed this by bringing in more deposits by increasing their rates that they're paying. But again, that tightens their operational products because they have to make it up somehow, right? So if they're paying 4 or 5% on their savings accounts just to keep them there, what does that do on the back end for the amount of risk that they're taking on for like the held to maturities or available for sale assets? Because you have to clear that 5%, right? You have to be able to pay depositors 5% that you promised them.
Right. I'm looking at a chart here from FactSet Research, and Silicon Valley Bank, they had the largest deposit growth out of all banks. I believe this is truly all banks, which would make sense. It's easier to grow a small number than a big number, right? Chase doesn't double very easily. Yeah. But because of the unique aspect of many smaller regional banks, they have mid-sized businesses as their relationships. And so that means that the vast majority of the deposits in these banks are over the 250. So you might be thinking like, well, I generally don't keep 250 in cash. I generally invest above and beyond that, right? So then it's invested and diversified, right? Well, if you're a business, you might have anywhere from 250 to $100 million in that bank. Say you're a startup, right? And you're paying things down. And so 97% of the deposits in Silicon Valley Bank were above $250,000. So that's what would be so such a big issue here, is that all of these 120,000 startups and VCs, half of those all banked here. If all that capital went away, we're not talking about the bank as much as we are people's jobs, frankly. Take a page out of innovation and what these companies ultimately become in the future. But we're talking about, people's jobs that are at risk if they can't make payroll, which is then making mortgage payments and car payments and everything else. So the trickle down effects of that type of a thing, because the bank is so critical, is actually quite huge.
Yeah.
All right, let's wrap up with what happens next. So it's a bit of a waiting game with more news, but in your view, what happens next?
I think we're seeing quite a bit of speculation and confusion, and that's leading to misinformation. I'm seeing money markets being targeted as the next possible run, but that's a very different animal here. And that's probably so complex and very difficult to explain, the reverse repo market, that I think that there's always risk in any kind of financial system as tightly wound as this is. But I think we need to table speculation for right now. It looks like the market is responding pretty positively to the depositor bailout. It looks like contagion could be, at least for what the market's pricing in, the contagion could be pretty much closed in, I hope. I think I wouldn't be surprised to see a few more banks go down, but if we can keep it to the ones that had assets in such high octane cash needy businesses, then I think Main Street, people like you and me, right, who aren't in the tech business, we will be able to access our money with no problems, without fear of a bank run with the people we bank with, right? So I'm with the credit union. I know credit unions are pretty tight with who they work with. They don't work with cash needy businesses because of the cash flow needs, right? They need a more stable round of funding from their depositors. And I think a lot of regionals, right? The regionals are down 9% today. I want to believe that a lot of it is throwing the baby out with the bathwater because two banks fail and all of a sudden the entire banking industry is weak. I find that really hard to believe, especially Midwestern banks who, are seeing a windfall from cost of energy going up, right? And we had this issue in Texas, Kansas City, where when energy crashed, those banks in those regions failed. But it wasn't Bedlam, right? I totally get that startups in Silicon Valley is the world's economy essentially, because that's probably the most expensive place to live. Mm-hmm. But I think if it's limited even to the most expensive place in the world, essentially, I don't think that contagion, especially with the background of why these banks failed for whatever reason, it's so niche. It doesn't seem like it would be a broad impact like we saw in the financial crisis, right? Because everyone knows a home.
Yeah, I mean, and to your point, it is the right move to have confidence and restore confidence in small to mid-sized banks. Otherwise, everybody's just going to go bank at Chase, B of A,
and
Wells,
they'll just get
right?
bigger, yeah.
And they'll just get bigger, yeah. And so, competition is good. And when you're a small business, Chase doesn't want to talk to you. When you're a huge business, Chase wants to work with you, right? And so, we've gotten a lot of emails from many of our providers saying, hey, we don't work with Silicon Valley Bank. And so, but if you're a real startup, I have a couple of friends that are in the startup community.
Me too. Yep.
Guess where they bank? Silicon Valley Bank.
Yep.
So it's a big deal. But we need these specialized banking assets, and hopefully, I think unfortunately it will likely get sold to a big bank. Goldman will buy them, or Chase will buy them, or something like this, because the FDIC is not going to be in the banking business. They're just going to broker a deal and sell the bank for its assets. But no, people need confidence in their small banks. That's an important part of our banking system.
Yeah, and I think the stock performance from the KRE ETF, it is, to me, it's a bit of throwing the baby out with the bathwater. But at the same time, we're most likely seeing or going to see increased regulation on these banks.
Yeah.
Right. At least to the pre-2018 levels where everyone should be stress tested, not just the big multinational banks, right? So yeah. I think stress tests are important. They're a burden on banks. I totally get it. But would you rather have a burden on the bank or a burden on the depositors? I pick the bank 10 out of 10 times.
For sure. Yeah. All right. Well, that's it for our update. We'll post again as more things come out. But essentially what our hope for today was just to break down what happened, maybe a little bit about why did it happen, how are you impacted, and what potentially happens next. So hope that was helpful for everyone.
Hopefully it's the last one.
What's
Hopefully
that?
it's the last emergency podcast about banks.
Right?
We'll see.
Hopefully we don't post again tomorrow.
Yeah. Yeah. If it is, if you see in succession on Monday, Tuesday, Wednesday, new episodes, then things are probably broken down pretty bad.
Yeah, that's right.
Let's hope it doesn't get there.
That's right. All right. Thanks everyone for tuning in.
All right. Thank you.